So we're setting up. So we've done our statement of financial position, set up basically. So Cyril, I've granted you the access. So stated our statement of financial position. We have our assets and non-current and current assets. Then we have our equity and liabilities. So we have equity, non-current liabilities, and current liabilities. And just for class purposes, we'll get our total equity and liabilities so that we'll check. Now we have our statement of profit or loss and other comprehensive income. So we'll leave the space for that and put all the necessary things within it. I want to leave maybe close to 20. So by 70 something, I should be fine. So I will do my changes in equity, even though that's not required in the question. So one of these questions, please, when you're tired of these changes, once you're comfortable with the changes in equity, just tell me so that I just want to beat it into us.
We can never be tired of it.
You said?
We can never be tired of it.
But you know that I want to make sure that you're very comfortable with doing it the other way. So for the year ended, what's the year ended? 31st
March, right? 2014.
Okay, so I'll just pick this same for the year ended. I want to put it same thing for the other one. I didn't put it earlier for statement of changes in equity. This space is not enough. Okay, so we're good to go. We have everything we need. So if you want, we'll just open. We usually need the question to guide us. And so our changes in equity will change. I'm glad we are even doing changes in equity today because it changes slightly. I remember as you were reading, we saw something on financial instruments. So when you have a financial instrument, the chances are that you would have a compound financial instrument that will give rise to doing some other things. So we have ordinary shares, right?
Yes. Share premium.
So after that, we'll have the premium. So share premium. Not every question will have any of these things. Then a more comprehensive statement of changes in equity should have. So revaluation, I'm not sure there's a revaluation in this question.
No revaluation.
No, Nabi? You're sure?
No.
I'm trying to follow what
No, I didn't see anyone.
Okay, so if we have,
I didn't see any revaluation.
If we have, we'll incorporate it. Hopefully it doesn't mess things up. So let's assume we don't have. I know that I saw you reading that 5% and was it 8%? So that one would definitely mean that you have an equity option. And this is where your experience will come in. So equity option out. Okay, I think it's just about squeezed into that place. Just adjust a little bit. And then we have our retained earnings. Okay, so with that, we've set up. So we just go and start what we do again. So we'll start from the beginning of the trial balance, and we continue filling in into all the things we've set up. So maybe we should also do this one. So we have opening balance, right?
Yeah, opening balance.
Then after that, we have our prior year adjustment, right?
Yeah.
Then opening balance restated. And then we have our movements for the year after that. And then we have our closing balance under that. In my experience, the only thing I would advise you is please try as much as possible to put your profit for the year, because the chances are that under the heat, you might forget that profit. The one that looks like most likely is the one that is very easy to forget. So just put the profit for the year so that you remember. Cyril, I listened back at what we were discussing yesterday, and he said something about that the profit for the year doesn't have any impact on the statement of financial position. It absolutely does. That's part of what you're going to add to retained earnings. So if your profit for the year is wrong, your retained earnings closing figure will be wrong. If your retained earnings closing figure is wrong, then your account will not balance, except you've made a mistake 2 times, or you've used an error of principle or something like that. So it will definitely affect the balancing of your account. Do you get that? It's in consolidation, when we do consolidation, that you might do 2 separate statements and they won't affect each other at all. We'll see that from next week. So we come and put our workings. So we have our working setup, and then we're good to go. So we start our question from beginning to the end. So for us to be able to make progress today will be, we'll just walk through it. So we have revenue. Revenue first, Abi?
Yeah.
So we'll go to
revenue 490.
Naturally, would have put revenue just straight to the end. But I heard when you were reading the question, and I know that your revenue is not.
Okay, there's additional information.
Yeah, even though they've not written anything for revenue, there is an additional information that affects revenue. I can't.
There is the first one.
Yes, I'm saying
revenue
I'm not sure whether 190,000, Abi. 3. Okay. Okay, so we go to our additional information for revenue. They didn't put any notes to it, but when we're reading, I saw that affects it. So they said revenue includes an amount of 20 million for cash sales made through XTOL's retail outlets during the year on behalf of Francis. So we're going to do revenue recognition, IFRS 15, on one of our, I think 2 Fridays from now. So our extra class that we're adding, our Friday class, we're going to do revenue recognition in one of those classes, I think 2 Fridays from now. And in revenue recognition, we'll see that if you're making sales for someone else, then the amount of sales you make is not your own. It's not your sales. You can't recognize the amount sold for another person because you do not have any performance obligation, and you do not have you don't meet the criteria for recognition of revenue. So if you're selling as an agent, so in this case now, XTOL is the agent, Francis is the principal, so XTOL cannot recognize revenue. And they said included in revenue includes 20 million for Francis. That revenue is not supposed to be there because XTOL is just acting as an agent for Francis. However, they said XTOL is acting as an agent and is entitled to 10% of the selling price of these goods. By the end of the year, XTOL has remitted 15 million
of the 20 million
sales and has recorded this amount in cost of sales. So we have to go and make an adjustment. And the logic to this is maybe one of the few cases where our use of debit and credit might be important for us, so that we'll be able to make sense out of what is happening. So our working one now. So work one, maybe we should call this, so you can call this anything, sale for Francis, as low as without too much, don't write too much in all these kind of things. You can say agency, whatever you feel comfortable with saying as your heading. So let me call it sale for Francis, for example. And so what we know is that XTOL is acting as an agent for Francis, and so should only recognize the commission earned as income. So now, XTOL has recognized 20 million in revenue. How much in cost of sales? And 15, I mean, 15 million in cost of sales. Now, also, since, okay, so let me say, these should be derecognized. Now, also, XTOL, or was this way I said since. So since XTOL is entitled to a 10%, right?
Yes, commission.
Commission on the sales. The income to be recognized is 10% of total sales. Full stop. So now, therefore, XTOL should ultimately remit, how much is that? So this total amount is 20 million. So 20 million less the commission to Francis. Now we can say, since XTOL has remitted, how much has he remitted? 15 million, right? That's what he called cost of sales. 15 million, comma. XTOL still should remit, so 10% out of 20 should have been 18 million remitted, right? It should have remitted 18 million.
18 million, that's plus the 10, plus the commission.
No, remove the commission from 20 million. So it should remit 90% of.
Okay, yeah.
So since XTOL has remitted, should still remit. Okay, so maybe I should just, for clarity purpose, maybe I should do one before that. I don't know whether that would help. But this thing now maybe should be after I say that how much you should remit so that you can follow that to the end. So XTOL should remit 90% of 20 million, which is how much?
18 million.
So she remit 18 million.
Okay, so 18 million.
So XTOL should remit 18 million to Frances. Now, since XTOL has remitted 15 million, XTOL should still remit the difference, Abi. Should still remit 3 million, which is 18 million minus the 15 million that he has remitted. Okay, so now correction of the transaction of the entries for the transaction. So we can come down and do basically our accounting entries. So first of all, debit, obviously.
Sorry, Mr. Brian. Sorry, please hold on, please. Where is this question? Because I'm looking at my questions. I can't get any questions. I'm not following.
110.
I'm not with my book. I'm not with my book here. Someone should please scream much or can snap and send. I'm not with my textbook here, please.
Okay. So we'll debit revenue. So we'll reduce revenue by the amount of the transaction because it is not revenue, right? Then we'll credit our cost of sales. So we'll credit cost of sales by the amount that they have recognized in cost of sales. Oh, we're working in thousands, right? So let me change that. Then we'll credit. Now, since we don't know now, I don't know whether information was given to us as to whether this sale is, whether the thing that XTOL is selling, the product that XTOL is selling is what the XTOL normally sells. But since it's working for another entity, now if you're working for another entity, then from one of the first classes, I think one of the first discussions I had with you, one of the things I asked was, what's the difference between income and revenue? Revenue is when you sell what you normally sell, but income is whether you sell what you normally sell or you sell something else. That's income. And therein comes why we have, we go to our statement of profit or loss. You will see that you start with revenue. Revenue is when you get income from what you normally sell. somewhere in the middle of your profit or loss. And we've not done that up till now. But you can have other income. Other income is when you generate income that is not what you normally sell. And then finally, we have at the end of our statement of profit or loss, we have our other comprehensive income. Other comprehensive income is increase in value, so increase in asset or decrease in liability that has not been realized. So we said that the prime example of that at this level is what?
Gain or loss on disposal.
Revaluation
surplus.
is revaluation.
Revaluation surplus is no other comprehensive income.
Once you dispose is other income. If you've disposed, then that's other income. You can realize that value if you've disposed. But if you've not yet disposed, especially a PPE that you're expecting to hold for a long period, other things that you will see, and something that might be introduced soon because that standard is already here, is things like something that has to do with foreign exchange. So effect on foreign exchange too is also stuff that you recognize in other comprehensive income. However, when you make sales, so for example, this agency relationship, we can assume that the sale made for Francis is not a product that XTOL engages in its operating activities. So in that case, it means that that income that is generated will be recognized in other income. So we'll actually put other income. And for other income now, it will be 20, how much? 10%, right? So that will be equal to 10%. Has someone screen munched the thing for her?
Yes, I've sent it to the group.
Okay, so 10% of revenue, right? Of sales, of the sales made. So of 20 million. So that's what will be recognized. That's what XTOL has a right to recognize. Okay, so that will be equal to 10% multiplied by 20,000. Okay, then the amount that XTOL has outstanding that should, so it should remit, we said that XTOL should remit 18 million to Francis. Right? So since XTOL has remitted 15 million, then XTOL should still remit 3 million. So that means what XTOL has is essentially what now? What's that in English or in accounting, in what we've learned? What is that?
Liability.
Yeah, a liability. What's the liability called?
What's it called? How?
Payables.
A payable. God bless you. So XTOL will have a payable to XTOL of 3 million.
3 million.
So we can say payable, which is equal to the original, the 18 it was supposed to remit minus the 15 that it has already remitted. So that gives us that 3,000. And basically that's all. So that just sits nicely as 2020. So with that, we've done what we are supposed to do. Is this clear? It's not the easiest thing you've done in your career. I know that. So it's something that I want you to look at. Was this supposed to be correction?
10%.
Is this fine? Somewhat.
It's fine.
Okay, so we go to, let's now start throwing everything now. So like always, when you're doing a published account, once you see that thing, then you open something for it. So revenue, we remember that that's a debit revenue, so we should go and reduce revenue by that amount. So we can come to revenue and say is equal to minus that figure. So we are reducing revenue by that amount. So that's sorted for revenue. How do we do cost of sales? How do we do cost of sales?
And we'll start from the aspect trial balance.
No, I said what I wanted to hear was that we should do a working for cost of sales. So immediately you see cost of sales. So you see that cost of sales can be what? You said what?
I know we'll do working for it.
So that's all I was asking. It's not by fault. You can actually throw it there, but it will become clumsy because it will usually take a number of things. So we'll have our cost of sales. So the first thing is per trial balance, Abi.
Yes.
Right?
Yep.
So we have our per trial balance. And then now we'll now have, remember we are reducing cost of sales. So this is something we've not seen before. So this one is not increasing. It's not depreciation or any of those things or impairment. This is reducing cost of sales. So we'll have sale for Francis or whatever we want to call that. So from work one, and then we'll come and put, and remember that that's a negative figure. So negative is equal to negative that figure. So that's reducing cost of sales. And then other income. So we can come and put other income in our statement of profit or loss. Like I said, I want to emphasize this one because we've never seen an other income before. Other income would be usually after our fixed costs. So after distribution, after admin and distribution. So I put revenue already. So cost of sales should be under that. So cost of sales, I know it's work 2 now. So when it comes there, then because some people like gross profit too much, something that will not help their career. So gross profit, then we have admin. So admin expenses. And then we have distribution costs. And then we can put other income under that. And then the other things we want are finance costs. And let's come and run it again and call it tax. So we'll call this tax expense until we see that it's tax income, then we'll change it. Then under that, we'll have our profit after tax. So profit for the year. And so what I wanted to do this was to check whether I had enough space before I get into this point. So we'll have our OCI under that. So other comprehensive income. And then we'll put the things we want. Oh, okay, you said there was no revaluation. So it might mean that we don't need other comprehensive income. So
No
see that we'll see if we have revaluation. So I shouldn't have extended this thing. Our profit for the year is the end. Okay, so we move on now. So we have other income. So other income, we come to the end and say is equal to wherever that other income was. That figure. And then finally payables.
2,000.
Definitely, I think I put it on the wrong place. Okay, then we'll have payables. So we can put our payables under our current liability. we should definitely have payables from our balance sheet, from our trial balance rather. So we have work 1.
Yes. You do.
Yeah, definitely, almost certainly you would have. So other income, remember to call the work for that. So let's put work 1 to there. So our payables now, we just put this after the original one. Payables is increasing. I think we've done the right thing. What did we do for revenue? We subtracted, yes, we did. So we have done the right thing. And so our payables now will be that figure. That figure goes to payables, adds to our payables. So we've treated everything now. We've done revenue, we've done cost of sales, we've done other income, and we've done our payable. So we're fine. So we've done everything we should do there. Okay, we'll move on if there's no other question. So we'll continue gingerly down our trial balance. So what's next? Cost of sales. Cost of sales, we can just pick the figure. We've already opened for it. So cost of sales, what? 290.
600.
290, 600. So that's done. We'll move on. Distribution costs. So where's distribution? So distribution is how much?
23,500. 33,500.
23,500. So we can just come and put it at the end. So if we have any issue, with it, we would adjust. But we can put it at the end because there's no notes to it. So 33,500. Then what's next?
Administrative expenses.
So administrative expenses, that's, I think I saw 36,800. So 36,800.
Yes.
So that's good. No additional information that they've shown us. So they said loan interest and dividends paid. I'll advise you for this kind of, anytime you see loan interest and dividend paid, I've said a few things going through, and it's just experience that you would use to get all these things. So once you see loan interest and dividends, especially because they are combined together, ignore that thing until you get to the end. At the end, you will see what it is. So you just continue. So we have bank interest. Bank interest is where? Where's bank interest?
Bank interest is finance cost.
Finance cost, thank you. So our finance cost for bank interest, they said 900, right?
Yes.
So 900, that's done. What's next?
Right of use assets, lease property, and
Okay,
cost.
so they said lease property. So that would definitely require us to go to our notes. So we'll go to note 2. It's not even interesting. Plant and equipment is depreciated at 12% per annum on a reducing balance basis. That's all the information they gave us, right?
Or amortization and insurance charge cost of sales.
That's very, very uninspiring. So nothing for, so our lease property, we're just going to do, okay. So lease property, oh, okay, so they like their self. So they've given us, okay, so that's accumulated depreciation. So we have 20-year lease property for 100,000 or 100 million, if you will. And then the accumulated depreciation for that is 25, right? And there was no revaluation for the property. So we're just going to take it as it were. So our costs, so we'll come and show some concept with appreciating changes in accounting estimates. So we leave small space for the cost of sales, and we go and see whether we can do this before we get logged out and have to come back again. So work 3 now, we're looking at, so we'll do them separately. Lease property. So our lease property, we'll have our costs. What's our cost for the lease property?
Lease property at cost is it's 100.
100.
So 100,000.
100. Yes.
Yeah.
And then accumulated depreciation. Now, please be careful. This thing is very simple. But be careful about something now. So our accumulated depreciation for lease property, I think I saw 25,000.
25,000.
Yeah, 25,000.
Yes, 25,000.
2030.
And then we have our carrying value at the beginning of the year, right? Because they said 1st April 13. So that's the beginning of this year, Abi. So carrying
Yes.
value, right?
Mm-hmm.
At 1st April 13 will now be equal to this value minus our accumulated depreciation. So cost minus accumulated depreciation. Then we now have, Ella, the noise is plenty from your side. So we have
From my side.
depreciation.
Oh.
I'm saying that is you. But I need you to be around though, so that I'll know when something goes up. So now our depreciation will now be equal to what? Remember, your depreciation is cost minus scrap divided by your number of years. So since they've not revalued, there's no revaluation issue, then we're going to still use the same cost. You said? No. The lease property. No, lease property. They didn't tell you.
lease property.
Plant and equipment that is.
Plant and equipment that is.
Okay.
Okay, so that will be equal to, and please, it's not your carrying value. Why we do carrying value is when you have revaluation. If not, it will be the original cost. So what we have here is cost. So it will be 100,000 divided by the 20-year life. Do you get what I'm saying? So it's equal to that 100,000. I hope this is not 1 million. Divided by 20 years. So that's 5,000. So from there, we can get our carrying value at the end. So carrying value at 31st, what's that now? March? Is that what we're publishing to? 14,
Yes.
right?
Yes.
So, please, where did we get the 20 years from?
The 20 years.
Yes.
It's not in the question. I saw 20-year lease property at cost. Is that not what you have there? Is that what you have there?
No, I've not seen 20 years ago. Did anybody else?
Okay, yeah, it's
No,
possible that my
Yes.
question, my question is not the same, exactly the same with your own. What I saw was 20 years. What did you see? You had right of use asset at cost, Abi? That's what I
Yes.
heard.
Lease
And they didn't
property
tell
at
you.
cost.
Did they tell you
They
how
didn't tell
many
us
years?
number of years. No.
But they had to have told you something, and they had to have given you information, some kind of information.
They didn't.